Last week, we took a look at the companies who rose their dividends over the course of the month of September. And one of those companies was Starbucks. But we thought things looked a little off. The payout ratio looked kind of high. So today we're going to take a look and see what the heck's going on with Starbucks. Because as I put more numbers into it, things definitely look a little weird with this company. If you are a dividend investor, if you love collecting those dividends, go check out that video and see if you own any of those stocks. Leave a comment on which ones you do and subscribe because every month we do that. But also, if you like to know the actual fundamentals of companies that you own or are considering owning, request a stock down in the comments, subscribe so you can stay up to date with everything, and I will put together something like this on that company. So to start, we're coming up with a fair value right around $100. Current actual price is $91.13. So a value investor would be looking for a margin of safety. We're saying 15% here is pretty standard, and that would mean $87 would be the target buy-in for the stock. And then we'd want to reevaluate around 113. And over the course of the last year, it's gone as high as 115.5 and as low as 82. Then we have some of the key numbers over here. So earnings yield, 2.83%. That is pretty low. With today's economy, we're looking something more in the realm of 5%, which to get 5%, they'd need to come in at $4.50 in earnings. And when we go to see what they're doing, we see last year they were 285. This year they're expected to be 345, and next year 408. So they're not quite to that point yet, which means that the stock might be a little pricey, at least on the earnings financial front. Cash flow yield, this looks pretty good. They're higher than average on their cash flow. 7.93 it's decent. It's above 5%. I mean, we really like double digits when we can get them. Dividend yield, 2.37%, which is a pretty good yield. They are pretty good at growing it 10% year over year for the last 3 years, slowing it down a bit more recently. So it looks like they're doing a static amount rather than a percent. And that's up from what it has been previously, of course. Payout ratio, this is what we thought looked strange. We're looking for something under 50%. 30 to 50 is ideal. 70 is approaching the danger zone where the company does not have a lot of wiggle room and may potentially cut the dividend down the road if they need to. Returns, equity is negative for this company. Definitely not something that we like to see. Common stock equity right here, but it is one of those franchise restaurant companies like McDonald's where their financials just work a little different. So it's definitely not a disqualifier, but it is something to note. ROI is decent, 9.38%, definitely fetching more than a bond is really what we're looking for there. So every dollar that they put in, they're able to pull out almost 9.5 cents. And a bond, you do almost 5.5 these days. So this is getting a 4% better return on their money. And on their assets, they're pretty low on assets and high on liabilities. This last year, they came in 27.9 assets, 36.6 liabilities. So they're coming up with awful balance sheet numbers. But for a restaurant, that doesn't factor in quite the same way as something in the retail space would or the banking space. Different sectors are definitely different on these fronts. And so we're going to discount the balance sheet a bit more and put the financials with a larger weighting. Profits are climbing. Net 9.5 came in at 10 this year. Gross, typically 19, came in at almost 26. So those are pretty good profit margins that we're looking at for something in the food space. They're decent. Revenue growth, they seem to be really good at growing their revenues. It picked up over the course of the last 2 years, but analysts are only projecting about 11% growth going forward. So we're plugging that into our calculation here. Earnings per share growth, they are all over the place. They're not very consistent on their earnings per share. And it's really not giving decent it's not giving decent numbers because we don't have a nice range, nor can we pick one because the consistency is not here. So that is definitely a strike against the company, where we're really looking for consistency in earnings in particular, especially when they're tied this closely to the share price. So the projections that analysts are giving are almost 20% growth. We'll see if that actually happens. Cash flow growth, again, that's one where they had a really low year in 2019. They bought back a lot of stock and came in with super low cash flows, which continued to drop in 2020 and then have been on the rise, peaking in 2021, 2.5 in 2022. So they don't even have really consistent cash flow yield across the board either. And again, it's going to be another strike against the company where inconsistencies make it difficult and make it hard to believe in the future of the company. And those inconsistencies are what are putting it on the bad dividend stock list as well. Assets, they were growing pretty well, and they've been cutting back more recently. Liabilities, they were growing quite a bit, and they're essentially stagnant, less than 1% move to the downside more recently. Dividends, they've been growing their dividend pretty quickly, as we touched on, but they need to bring those earnings per share up and be more consistent. So if we use all these metrics, we say they continue with 11% growth like analysts are expecting for revenue. Share count, they buy back 1.5%, especially where it seems like it's at fair valued, if not a little overvalued at the moment. So we really don't want them buying back too many shares. Assets, they sell off 2%, a little less than they've been doing more recently. Liabilities, I put in 0.6%, a little less than more recently. And then dividend growing at 9%, which going forward, if they are stagnant in the amount, then this percentage is going to drop year over year. But the returns that we'd be looking at off of this would be in 3 years, $110 per share, for a growth over the next 3 years of $7.31, or 8% growth, which is awful when we'd want 8 to 10% growth in any given year for our baseline. So this, over the next few years, if you get in at the current price, you're probably going to underperform the market. Over the course of the next 5 years, though, we're looking at growth of $34 up to $136.50, 33% growth over the course of 5 years. So that's better, but that still is behind the market by about 1 year. So those values were based on the fair value, but what if we do the actual current value of the stock? It's a little above our margin of safety, but if you don't think it's going to drop, would now be a decent time to buy shares. So in that case, we'd be looking at 20% growth over the next 3 years, which equates to $18.50 per share. 20% is barely underperforming the market. So we definitely would want to get something closer to this margin of safety. 85, anything under 80 would be great if they can continue with these numbers that they've been putting up more recently. And then over the course of the next 5 years, they would actually be forming essentially on par with the market, giving an 8 to 10% return every year. And then we have, for reference, just a breakdown of what it would take for the current valuations. So typically we're looking for a 15 PE on a company. If it's a bigger brand, has a wide moat, then we can raise this up a little bit. This stock has traded at insane PEs, partially due to the inconsistencies in the earnings. and it's been pretty flat in its price too over the last 4 years. But if we bump this up to, let's say, 19 PE, then we would want a earnings per share of at least 480 to warrant a share price of $91. And in 2024, we're looking at $4.08. So it'd probably be about 2025, if not 2026, when we're seeing values like that. Cash flow, we want to see cash flow per share of $4.50, which equates to $5 billion in cash flow. And this last year, they came in at 2.5, so they're halfway there. 2021, they came in at 4.5. So they do have potential to get up there, but they are definitely not there yet. And then the balance sheet, we'd want net assets per share of $30.38, which would equate to net assets of about $35 billion. And this last year, their assets were just shy of $28 billion, and their liabilities were $36 billion. So they're underwater on their balance sheet, which is definitely not a good look. But none of these are really anywhere close to what we would be looking at for today's price. Which is why I said things are looking a little weird for this company. They're not going to hit the earnings goal until 2025, maybe 26. Cash flows, they might hit that in the next 2 years as well. Balance sheet, again, being a restaurant company such as this, it's a little different. So we can just focus on the financial one on this company. And what I'm coming up with is they just have a lot of growth going into them. Fair value at the end of this last year was 89, and it's going to hop to 101.5, and then it's going to hop to 116.43 based on how they've been performing. Things could change here quite a bit if they were to start to grow their assets again and continue shrinking their liabilities. We'd see a whole lot better number there. And if they could get their revenue up and buy back shares, that would in turn bring up their earnings per share. But the price does seem, in my opinion, a little elevated right now. It's trading at valuations of probably about 3 years out. This kind of cash flow up here, again, the cash flows are so inconsistent that we can't come up with a good number. The financials, we see the revenue growing nicely. COGS are growing at the same rate. Inconsistencies across net, gross, and EBIT. Balance sheet is essentially flat. Liabilities essentially flat. Tangible assets negative. Tangible book value is negative. Definitely things I don't like, but we talked about why that might be. Cash flows incredibly inconsistent. Dividends are the one good thing here. Some nice growth over time. The price, I feel like things look very flat here. Aside from the earnings, which are continuing to push forward as long as they can hit analyst targets. When we look at everything as a whole, $91 price doesn't seem too bad. It is in the middle of all our valuation metrics, and it is towards the upper end of the midpoint, pulled up mostly by those earnings. But here's the thing. That earnings value is a PE ratio of 58.3 because there was a year in 2020 where they only had $1 and they were trading for over $100. So if we take out 2020 and we look at things, out the one number that's skewing everything, things are very different. So a 30 PE ratio, and this is how I think that the stock should be looked at, because if you do this, the fair value drops down to $75, which I said would probably be about the point that like I'd start to be willing to buy in, but I would definitely want to buy in around. But even 32 is a very high PE. They don't have massive growth that would warrant that, so I feel like in the 20s. So there's too much growth factored in here. Once we cut that PE ratio, investing at today's price, even if they're able to come in with all of this, which we said was a good case from, you'd be losing out 3%. So that's probably why the stock has been pretty flat over the last 4 years, is it saw tremendous growth and it's just kind of floating at that level, waiting for the fundamentals to catch up. But now that we've adjusted things, the fundamentals are not going to catch up for another 4 years. And that's what we're looking at this stock. So hopefully you enjoyed the video and you learned a bit more about how to evaluate stocks and their fundamentals. Let me know what other stocks we should look at down below, and I will catch you next time.